Should you need assistance during the conference call, please signal an operator by pressing star and 0 on your touchtone phone. I now hand the conference over to Mr. Nihal Mahesh Cham from Edelweiss Securities Limited. Thank you, and over to you, sir.
Thank you, Aman. On behalf of Edelweiss, I would like to welcome you all to the Q3FY22 earnings conference call of Welspun India Limited. I would now like to hand over the call to Mr. Abhinandan Singh, Head Group Investor Relations at Welspun Group, to introduce management and take it further. Over to you, Abhinandan.
Thanks, Nihal, and good afternoon, everyone. On behalf of Welspun India, I welcome all of you on the company's Q3FY22 earnings conference call. We have with us today Mr. Rajesh Mandariwala, Managing Director, Ms. Dipali Goenka, CEO and Joint Managing Director, Mr. Akshay Jindal, Group CFO and Head Strategy, and Mr. Sanjay Gupta, the company's Chief Financial Officer. As usual, we will start the forum with some opening remarks by our leadership team, and then we will open the floor for your questions. Once the call gets over, should you have any queries that remain unanswered post the earnings call, please feel free to reach out to us. And with that, I would like to hand over the floor to Ms. Dipali Goenka, our CEO and Joint MD. Over to you,
Dipali. Thank you, Abhinandan. Good evening, everyone. Thank you all for joining us today. We hope that you are safe and in good health. While India has witnessed a sharp rise in COVID-19 cases in recent weeks, the impact of the third wave has been mild so far. The trajectory of the pandemic is still evolving, and the recent increase in cases has slowed the pace of economic activities in January, but we expect the economy to regain momentum as this wave abates. Our board today approved the financial results for the quarter ended December 31st, 2021, and I would like to highlight some key points. The company delivered a resilient performance during the quarter. Our unique value proposition to our customers, right from demand planning, forecasting, logistical support, innovation, traceability to quality-defining products, ensured a stellar top-line performance, even in these challenging times. The business continued the growth momentum that we saw in the last 2 quarters, clocking revenues of 2,438 crores in quarter 3, growing at 19% year-on-year, and 7,130 crores YTD, growing at 36% year-on-year. The home textile business delivered revenues of 2,251 crores, growing at 14% year-on-year, and 6,718 crores YTD, growing at 32% year-on-year. And we are well on our way to another milestone of reaching $1 billion revenues in home textiles alone this year. The U.S. economy, which is the largest market for Welspun, has been showing a strong comeback. Advanced estimates of U.S. retail and food services sales of 2021 were up 19% year-on-year. On the back of this growth, we saw our home textile export grow by 35% year to date. The market share gain and growth have been broad-based across the key businesses. Our flooring businesses grew 95% year-on-year in quarter 3 and 136% YTD. Domestic business continued its upward trend, witnessing 55% growth in Q3 year-on-year and 88% YTD. This demand resilience has, however, been accompanied by significant increase in energy costs, highest ever commodity prices, and continued global supply chain disruptions. As per Kotluk index, cotton prices are presently at one of its highest levels ever historically and touched USD $2.64 kilos level this month. Elevated cotton prices due to the increased demand of cotton and yarn resulting from factors such as U.S. ban on cotton products from China's Xinjiang region, which accounts for 1/5 of the global cotton production, and expected shortfall in supplies, continue to create serious challenges on revenue and profitability. While we have again gone back to our customers for price increases during the quarter to mitigate the quarter 3 cotton price increases, impact of which would start coming in from Q4, we are now again seeing more than 20% increase in cotton prices recently, Hence, we are watching and monitoring the current situation closely, and we may have to revisit our pricing strategy yet again. On the logistics front, the industry continues to face heat due to container shortages, port congestions, increased ocean freight rates, and sailing time. Further scarcity of truckers in a key end market, that is the US, is leading to serious challenges in movement of goods, including last mile deliveries to the retail stores. The partial availability of holiday season goods at shelves led to upheaval in retail, impacting demand and sales at retail level. We currently foresee a resultant glut of stock in the supply chain, an increase in prices, leading to a potential rebalancing of demand and a transitory correction going forward. We, however, continue to see positive results of a continued focus on growth drivers, innovation products, D2C initiatives in brands and e-commerce, our emerging businesses, and a commitment towards ESG and sustainable growth. Our innovation product sales during the quarter were 510 crores, taking YTD sales to 1,636 crores, registering a YTD growth of 24% year-on-year and contributing 26% to the sales. The e-commerce and branded business at 388 crores grew by over 45% Y-on-Y, accounting to 18% of our revenues, with US leading the growth with 157% growth in US branded business sales Y-on-Y. We added 325,000 unique customers in Q3, and through Black Friday and festive period, over 15 Welspun programs were amongst the top 100 ranking across the categories. In the US, our licensed brands recorded 66% growth in the calendar year, and these have taken up 175% over shelf space with the key retailers. We are committed to grow both e-commerce and branded business to $100 million run rate, each by 23 and FY24 respectively. ESG continued to be the focus area for us through the quarter, as we view embedding sustainability as responsibility and opportunity to reinvent our business and the textile sector. Some of the highlights of Q3 are: Welspun India has been rated by Dow Jones Sustainability Index, one of the world's most renowned sustainability index, through the Corporate Sustainability Assessment 2021. And in this maiden assessment, Welspun India secured an ESG rating of 48, which is 62% higher than the average industry score. Our efforts to conserve, reuse, and recycle water are path-breaking and led us to winning the National Award for Water announced by the Ministry of Jal Shakti. The recognition came on the back of the social and environmental impact made by Welspun's cutting-edge sewage treatment plant in the drought-prone Kutch district. Frost & Sullivan and the Energy and Resource Institute, TERI, also recognized Welspun India for its sustainability practices and impact on the environment and communities at the Sustainability 4.0 Awards. Sustainability remains at the core of what we do, and through our Welkrishi program, we aim to build a strong, self-reliant and prosperous farming community that empowers over 15,000 farmers and 75,000 farm workers across more than 350 villages to sustainably produce over 15,000 metric tons of cotton from 80,000 acres. Circularity adopted across businesses with focus on use of recycled content in both textiles and packaging. Welspun joined Sorting for Circularity India project, anchored by Fashion for Good Amsterdam, a consortium project which aims to build a new textile waste value chain in India. As a leader in home textile manufacturing sector, we see extraordinary possibilities to increase our positive impact. Be it our aim to be carbon and water neutral by 2030, obtain 100% of our cotton sustainably, or impact 1 million lives through corporate social value interventions by 2030, our ESG efforts drive measurable results. Domestic retail. Domestic home textile business recorded the highest ever quarterly sales of 127 crores, exceeding 100 crore sales for the first time, up 55% year-on-year and 40% quarter-on-quarter. Brand Welspun distribution now covers 470 towns and 5,424 stores, with 550 store additions in the past quarter through strong acceleration plans. Spaces became the #1 brand on Myntra, while also witnessing the highest traffic on Spaces' own website. in the current year of about 5 lakh plus customers in the month of November. Spaces launched its unique air purifying range collections with a 360 campaign of digital, OH, print and theatre with 14 million unique reads. Advanced textiles. Our advanced textile business revenue during the quarter stood at 63 crores. Spunlace business has been a revival in demand after stocks correction in all markets. However, escalated sea freights continued to be challenging for Europe, South America, and Far East markets. New orders were secured in North America, and wet wipes business added an upcoming Indian brand for wet wipes and another in cosmetic sheet mask. Industrial sulfuration demand continued to be healthy. Spunlace capacity at Telangana is underway and is expected to start commercial production in Q4 FY22. Flooring business. We are enthused by the growth being witnessed in flooring business, which grew 95% year-on-year and 20% quarter-on-quarter, achieving a record revenue of 191 crores. We continue to add additional large institutional customers in US and UK and also made inroads in hospitality chains in UK on the back of strong product differentiation. The hard flooring capacity usage has been enhanced significantly and is fully blocked now. Sales momentum is continuing on domestic flooring business, seeing a healthy growth quarter-on-quarter. Digital channel sales continue to do well. Marketing festive featuring Amitabh Bachchan pre-Diwali had a reach of 103 million, and post-Diwali brand participation in India-New Zealand cricket series clocked a cumulative reach of 173 million. On product assortment, we added warm wood tones and click and lock styles assortment. Flooring received Recycle Claim Standard 100 certification for recycled polyester in carpet tiles. Our order book remains strong for exports, and our domestic business is showing green shoots and is adding to the top line of the division. Now, I would like to hand over the call to Sanjay to provide updates on financial numbers. Thank you.
Thank you, Dipali. Good afternoon, ladies and gentlemen. Many thanks for joining the Q3 Financial Year 22 India earnings phone call. I'll give a brief overview of the financial numbers for the quarter before we open for question and answers. I'm delighted to share that during Q3, the total income grew by 19% year-on-year, and it stood at 2,438 crores. YTD December revenue grew by 36% to reach 7,130 crores. We earned an EBITDA of 331 crores in Q3, and EBITDA margin stood at 13.6% as compared to 16.9% last quarter. YTD December EBITDA stood at 1,178 crores, that is 16.5%, growing by 11% year-on-year. Coal price increases, higher logistics costs, including about 4 times ocean freight hike, and jump in commodity prices all resulted in this adverse impact. As also mentioned by Dipali, we believe this to be 34% YTD year-on-year. Our consolidated EPS for Q3 of financial year 22 stood at rupees 1.34 as compared to 1.80 year-on-year. YTD December EPS is at 5.52 as compared to rupees 4.08 last year, growing by 35% year to date. On the forex front, as per practice and as mandated by board, we continue to hedge about 65% of our future receivables. Our average exchange realization for this quarter was 76.59 versus 74.08 in the corresponding quarter last year. Net debt of the company stood at 2,542 crore, a marginal increase of 9 crore over September 21. We have in hand over 377 crores of ROSCTL and RODTP scrips receivable and still to be encashed. Along with this, we would have been lower in net debt position as on December 21. The expansion projects of flooring, advanced textile and home textile businesses, which were started last year, are in different stages of progress. Capital spends in financial year 22 on projects is expected to be around 550 crores, out of which 450 crores is already spent YTD December 21. Coming to segmental results, Q3 financial year 22 core business home textile revenue stood at 2,251 crores versus 1,967 crores during the same period last year, growing by 14% YOY. YTD December 21, corresponding revenue was 6,718 crores, growing by 32%. Q3 EBITDA of home textiles stood at 313 crores at 13.9% as compared to 413 crores in Q2 at 17.4%. YTD home textile EBITDA stood at 1,170 crores, EBITDA margin being 17.4%, growing by 5% year-on-year. During the quarter, revenue from flooring business was 191 crores, up by 95% and 19% Q1Q. YTD December flooring revenue were at 472 crores, up 136% year-on-year. EBITDA was at plus 10 crore as compared to a loss of 24 crores last year. YTD December EBITDA is at a loss of 11 crore vis-a-vis 80 crore last year, a substantial improvement. The business is also witnessing significant increases in input raw material costs and higher freight costs, but we are passing on the cost increase to our customers, which has a lag time of a couple of quarters. Emerging growth businesses, which include branded business, e-commerce business, flooring, and advanced textiles, cumulatively grew by 62% year-on-year and contributed 26% to the top line during the year versus 22% contribution in financial year 21. With this, I leave the floor open for question and answer. Thank you.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Anyone who wishes to ask a question may please press star and 1. First question is from the line of Ritesh Gandhi from Discovery Capital. Please go ahead.
Hi. We've been hearing kind of positive commentary on the overall export home textile business from all of the players out there. Just wanted to get your own sense on, is this a demand because end market is growing, and then in turn, how long is it then sustainable? Is it India is actually going to continue to gain share, and how large do you think we could ultimately end up given our shares already quite high? Or is it some inventory issues, or how should we be thinking about the long-term growth prospects of the export business?
Yeah, thank you. I'll just give a perspective. I think we have talked about the supply chain glut that is being there. And the goods, I would just give you a perspective that the goods in fact, the Christmas season also haven't reached the shores of America. So there has been a complete delay on the east and the west coast. And the home textile and the holiday season reported a growth of 14%, though in the holiday in December. But however, with the commodity challenges, the retail correction that we are seeing in the terms of prices, we definitely will see some correction happening in the Q1 and Q2. So though the long-term plan for home textile looks good, but as of now, there would be an interim blip because of the supply chain issues, the commodities, and the price corrections that we'll see going forward.
Looking slightly ahead, I'd say 2 to 3 years ahead, maybe even 5 years ahead, how, given you guys are obviously the largest exporter out of India and even major exporter in America, how do you see overall end market growth between? Kind of like leaving aside any like quarterly actually blips which may happen in the next 9 months.
I still didn't get your question. Could you just clarify that, please?
Sure. Question is like given slightly a longer term outlook, actually 5 years out, how do we see overall like growth in the industry being per se as an exporter?
So I think for us, definitely USA is been growing and will continue to grow, and UK, Europe, and rest of the world will contribute. But for Welspun as a company, we will have a domestic play that is going to be very, very strong, because as we see the Indian economy also growing very robust, we will definitely see a contribution of the Indian economy and the Indian brand spaces and Welspun coming into play here. And definitely that is going to be a very big play for Welspun. So overarching, yes, to your question, the geographies will grow, but for Welspun, the focus on our emerging businesses like our brands in India spaces and Welspun, our flooring business will definitely be something that we will see a lot of impetus contributing to our top line as well.
Let me add to that, and so overall, see, there is the consumption is growing. So there's no doubt, and through this COVID period, it has gotten reinforced. And just like Dipali said, there's almost a 15-20% year-on-year growth during this Christmas holiday season. So, and this I'm talking about America. So there is robustness in demand, which we have seen over the last 2 years. Also, clearly now with this Indian cotton situation, so it makes it that much more difficult for China now to export particularly cotton products and towel sheets from India, predominantly cotton. So that also is clearly playing to India's favor and the leading players here in India. So while there is I agree there is a disproportionate share of India within this particularly the categories of sheets and towels, but there is room for that share to grow. So that is one. And two is it clearly opens up possibilities in other categories where China historically has been very, very dominant, and things like fashion bedding, where India has got an insignificant market share and China is north of 70% of all imports into the US. So, and likewise, let's say the rugs and flooring products where China has got a very decent share. So these are categories which which could actually end up growing much faster. So even if you take a let's say 5-year view, our thinking is that this India's market share will continue to grow, both in cotton products and there'll be also acceleration on non-cotton products because of the China plus one factor.
Good. Sir, and anything on the FTA updates with regards to EU update, FTA or an FTA with actually UK?
So Ritesh, there are 3 FTAs currently under discussion, and they have been under discussion for donkey's years now.
Yeah.
But what we know is being let's say this part of the association and policy making process. So there is very, very serious intent now that we see from our Indian government to actually see these agreements through. So there's an agreement with EU. There's one getting discussed with Australia. There's one getting discussed with Canada. So I think there is renewed vigor. But these things are easier said than done. So while we are seeing energy, this we'll have to wait and see by when they actually materialize.
Thanks.
Thank you. Our next question is on the line of Prathamesh from Axis Securities. Please go ahead.
Yeah, hi sir. Sir, I want you to shed some light on your flooring business. So what exactly is our current capacity utilization, and when will we reach? So is the capex completely done? And what's the market scenario like? I think we are largely catering to the US market. So any light on that?
So, as Dipali mentioned, there are several parts to our flooring business. So our hard flooring business has picked up very well, and our primary market, of course, is America. It's picked up well. Having said that, this rising commodity prices and the supply chain ocean freight prices. So the margins are not where we would like them to see, and we are making best endeavor to pass on all cost increases to the customers, but it takes some time lag, and also there is a sensitivity involved when you discuss pricing with the customer. So you go too aggressive, you'll go out, get your price increases, but then the consumption starts deflecting and reducing. So we are moving in a very calibrated manner. We are not so happy with our progress on the soft flooring side. We can do much better than where we are. But obviously, with offices remaining closed for a better part of the last 2 years due to COVID, and our biggest product being carpet tiles, the demand was very slack, and so it's the numbers are not where we want to see them. And the other part is, of course, the wall-to-wall carpet area, where we are seeing better traction than carpet tiles, but again, not as much as one would like to see. Having said that, over the last 3-4 months, some significant progress on business development has been made. We believe these developments will get fruitioned over the next couple of quarters, and we will see this healthier capacity utilizations on the soft flooring side, and I'm talking about the international markets here. And for the domestic business, it's the same story. So for the better part of the last 2 years, offices remained closed. There was circumspect this attitude of people to let people into their houses to get their floors done, and so on and so forth. Having said that, last quarter we achieved where we were pre-COVID. So this Jan to March 2020, our October to December numbers in the domestic market are by and large this better than where we were in that quarter. So we've reached there, and now we are seeing let's say traction coming in the domestic market as well, and these efforts are being made to become more penetrative with our distribution network. Also, we are discovering, let's say, what is the right channel of marketing, and so on and so forth. So all in all, I think this as a company we are making good progress. So we've done about 190 crores in revenue and growing and counting. In terms of capacity utilization, we are at about 40 odd percent, and there's also within this idle capacity that we have, we try and make product for our rug units. So we make grage rolls and send it out to our rug business. So we try and keep some equipment occupied from that perspective. But from a hard, let's say, this flooring business intent perspective, we are at about 40%, and there's a large room to grow. Also our products are now distributed in 10-12 countries on a regular basis all over the world, both hard and soft flooring. So rapid progress is getting made, and we are hoping to see better traction come in the ensuing this financial year. So this in summary, we are not too happy with the progress we are making on the soft flooring side, where we believe the traction will start coming in a couple of quarters. On the hard flooring, while this good progress is being made on the top line, our good efforts are in a way getting negated by the constant increase in commodity prices. But having said that, we are all very happy and enthused with the way our businesses has come about despite the COVID situation. We believe we have a winner in our hand. We believe this business will grow will achieve potential which we have been talking about for the last 3, 4, 5 years. And we also believe that the margins that we are aspiring will also come, albeit will take a couple of years for the margins to fructify. But this all in all, I think we are seeing enough in the marketplace to to give us the enthusiasm and confidence that we'll eventually this hit the numbers and the glory that we all set out for when we actually started this business.
Okay. Thank you, sir. So, my second question is regarding the P&L. So there is one exceptional item, and also your interest cost has reduced despite increase in your debt. So, just clarity on these two things.
Yeah. Hi, Pratish. So the exceptional item that you see in the P&L is for the quarter 3 of about 36 crore. This is we have taken provision because of the reduction in the realizability of our scripts in ROSCTL and RODTP. So that is the exceptional item that we have taken. Interest cost, yes, it's slightly down because we got some interest incentives from the government and in this quarter, and that was accounted for in only in this quarter, and that is why it has reduced our total overall interest cost. The interest related to also flooring division, the incentive that we got.
Okay. So do we expect these incentives to be continued in near future? And also regarding the 77 crore of the e-scripts left with us, do we see any further exceptional charges coming in from those as well?
So interest, first question, the interest incentive would continue, but not to that limit. So it will now normalize to quarterly one. And as far as 377 crore of scripts in hand, we believe that we will be able to, not incur a higher cost than what we have provided for. We would try to achieve within that.
So let me just clarify. So the benefits that we have in our flooring business will continue by and large through the tenure of the loan. So the reason why we got a disproportionate credit this quarter is because this is the first time the incentive got received. So whatever got received, in fact, the provisions that we had made for interest incentive were lesser. And we ended up, let's say, this getting more eligibility, and which was of course entitled. So, and we were conservative in making this projected gains. So there is a disproportionate gain which has come in this quarter, but the interest incentive will continue through the tenure of the loan as per the state policy. The state policy credit and the policy benefits that have been allowed to us. So I hope that answers your question. And the rates of the scripts are actually moving up now and not down. So we believe that there's no further provisioning that will be required on this account.
Okay, sir. Thank you. That's it on my side. Thank you.
Thank you. A reminder to our participants, please press star and 1 if you wish to ask a question. The next question is from the line of Aman Madrecha from Augmenta Research Private Limited. Please go ahead.
Yeah, actually, I have 2 questions. The first one is regarding, can you explain the reasons why there was a dip in margins of the home textile business quarter on quarter? Because in quarter 2, we're standing at around 17 to 18% EBITDA margins, and the margins have come down to 14% currently. And also, what is the sustainable range of margins we are looking at the home textile space? Because YOY in Q3 FY21 we did a margin of 22%. From that time it's coming down only. So are we not able to pass on the increased raw material prices to the end customers, or what is the scenario happening in this space?
So I just want to add on. I think that's the question, or anything else?
Yeah, that's the question.
So commodities are at the historical highest ever, and it started from 47 to 55 to 65, and we have taken 2 price increases, one in June, July, and the second was as close to November and December. But even to the extent of just yesterday, the prices have gone up again by 20%. So fundamentally, it takes time for the prices to be passed on to the customers. and it is a consumer market that we must appreciate. And definitely the retail prices then definitely get impacted, and hence the buying also gets impacted of the consumer. So we are let's not forget, we are at the record highest of prices in the terms of cotton, in the terms of coal, power that is, and energy and supply chain upheaval. So definitely it definitely has reflected in our margins. And we have managed to pass on the prices in November and December. And now we are exploring what needs to be done in the next run, because if we are going to pass on any more, it's going to definitely impact the retail as well. So, however, we have already had 2 price increases.
So to clarify, this all costs by and large that increase until November were passed on, and they were passed on through 2 price increases to clients. And so it's not about the ability to pass on the cost increases to the clients. So, but we need to be sensitive, and if we rush things through, it might actually affect sales and negatively impact top line. So we need to be mindful of that. Also, the prices of cotton have gone to now 77,000 rupees a candy. So if you compare this to November, we are already 35% higher from that point. Now, these kinds of increases will certainly take first thing is we need to see how long are they sustainable, are these prices going to stay, are these prices going to react, come back to more realistic level. So, we can't just jump the gun and start shooting from the hip. The next day the price of cotton goes up so we need to allow it some time. We believe we need to allow another month or 2 before, before the cotton prices really settle down, and then go back to our clients asking for, the increased cost back to them. So, that is the intent. And as I said, there is a need to calibrate because, back-to-back knee-jerk, this significant this price increases could severely dent this top line as well. So we need to calibrate. This is not new to us, and we have done this the last time around when cotton prices actually this crossed $1, and we did it over 3 price increases. We have gone through 2 this time. Hopefully, if there is need, we will go back to the clients with a 3rd one. And to a very important question that you asked, what do we believe is our sustainable margin? So gentlemen, this over the last 10, 15 years, this company over any 5-year period has delivered a 20% EBITDA margin. The business is strong enough, good enough to continue to sustain those levels of margins. Unfortunately, you will not see that over the next couple of quarters, but eventually this we will pass through everything, and this hopefully some cost this benefit will revert back, and the rest of it we will pass it on to the clients again. We have historically done it for 10, 15 years, and there's no reason why we should not be able to do it again. And the clients are all receptive. We are in this together. These are strategic relationships. So as I said, we are calibrating the whole approach. And mind you, this when we get a tailwind, so as a company, we've also delivered 25, 26, 27% margin. So, this is a necessary evil. The cotton prices will keep going up and down. Unfortunately, this time, they are up 65, 70% and continue to rise. So, it's taking its toll on the margin, but we have seen this all in the past. This is nothing new. And, this eventually we will get back to our historical level of margins, and which is around the 20% mark. Now, it could be a percentage here and there, those things can happen, but eventually we will get there. But I'm afraid it won't happen in the next 2 quarters.
And sir, I had one more question. I just wanted to know till what level we are integrated in terms of backward integration from the yarn side and spinning side. Like what portion of the yarn is captively consumed or produced in-house? Just a percentage number on that side, if you can help.
So good question. And so historically, this, if you look at, let's say this our capex plan, so we have actually not invested much in spinning over the last 8-10 years, and at current consumption levels, we are almost 40% of sourcing of yarns and other materials from the outside, and we produce 60% of the yarns of the consumption that we need. So, and this has served very well for us. We believe that, this historically, that spinning is the lowest ROCE, let's say this within the value chain of textiles. It's of course different the last couple of years where the margins have shot up, and candidly that has reflected on our margins as well. So, but this being light on spinning has served us well for 15-20 years, and and we think this give or take a few quarters, but the spinning margins will return back to normal, and when that happens, we are comfortable with our current this blended strategy of making it in-house and continuing to source yarn and fabric from the outside. So that I candidly confess that at this moment it is hurting us. Perhaps this is the first year when it has hurt us. Over the last 15 years, I believe we have always gained by sourcing yarn from the outside.
So just to clarify, like 60% is sourced from outside, right?
40% is sourced from the outside.
Okay.
60% is made. Yeah.
Okay. And sir, just one more addition to this bit. Like, are we seeing any supply side issue from the yarn? Like, is there any supply side issue on the cotton yarn front, or it's easily available?
I think I can take that one. The supply chain is, the challenges are in the costs and the prices. That definitely is that's where we definitely see kind of a challenge for sure. However, while we might be looking at the availability of fine yarns, the coarser yarns have been a challenge. Somewhere I think there has been the supply chain disruption, and also in principle the availability of cotton in the scenario. So there has been a little disruption that side, but I think going forward we'll be able to. I think it is going to be mobilized.
Okay. Thank you so much.
Thank you. Our next question is on the line of Diman Shah from One Up Finance. Please go ahead.
Thank you for the opportunity. Just delving a little bit on the previous question. If one sees the drop in the margins from 21-22% to, I'm talking about YOY. And if you juxtapose the capacity utilization, you have also gained from the operating leverage, so-called, on an overall basis. So if one has to kind of dissect, cotton sourcing is well within you. The logistics costs, which is possibly exogenous to the company. And the third part is the operating leverage. So you have already also gained prima facie, I would presume so, from operating leverage, which means the margin dilapidation has been slightly higher. So how much do you hope to recover over next few quarters? And especially this is a repetition because from the other textile companies that we have interacted, their ability to pass on, somebody like an Arvind, of course the segment is different, but their ability to pass on has been much higher. So and given that, in home textiles, the value per se is much higher than a garment, is there some resistance to the price changes or our ability to, take on price increases, because this is a phenomena which the buyer would be knowing very openly?
So I'll pitch in here, and Arvind, if you can just pitch in later also surely. I think one thing when you're talking about Arvind, they are very seasonal in the terms of garment. It's fashion oriented and the season oriented. For home textile, it is core, and 70% of our business is replenishment business.
Sure.
And this is core business, and hence the pricing plays a very key role in the terms of a unit cost for a retailer. So it's very, very different. So while an apparel manufacturer or a garment manufacturer, it's easier for him to pass because it's a season season to season that he can take on that price. So that impact doesn't show and reflect that much. Vis-a-vis a core business, which is a replenishment program year on year, our programs are going on for now over 5 to 6 years. So that definitely does impact on the retail as well. So that definitely is a key thing if you comparing it to garments. However, I think even looking at, and we spoke about it, our relationships with our customers is very, very strategic, and we have managed to pass on 2 price increases. And if you can literally say that if you talk about a towel or a sheet, if you increase the retail prices to that extent where you're seeing the Kotlook index go up by over 60 to 70% in the past 7-8 months, I think it is a tremendous impact for the consumer. So there would be a very calibrated reaction to that. I must say that.
Agreed. I mean, just to recalibrate that question, what is the amount of price increases you need to take to, if you have to be, in line for the previous margins that you have, just done? So what is the percentage margin, percentage hike that you would need to take just to be in line with the last year, for example?
So let me take this, Dipali. So, this is a constantly moving goalpost. So this
no, if we freeze the cotton prices to the current prices, which is what you mentioned about 77,000 rupees a candy.
Correct. So this is exactly what I was saying previously, that everything until November was passed on, gentlemen, through the 2 price increases that we gained. By and large, everything got passed on to the customer. So it's not about the ability of the company to pass this thing on. And we have great and strategic relationship with our clients, and there's a fair degree of transparency in the way the product gets costed. The question is that how swiftly do you want to go back to your clients? Abhi November mein khatam hua nahi, uske baad hum fir this again we go back and sit in front of them in January. So the business, there is a risk of the business getting disrupted. And what I mean by that is that sales could just nosedive if we don't be careful in this area. So the company is now 25 years into this business and understands, let's say, the consumer behavior. And so it needs to be handled very delicately, very sensitively, and some patience needs to get exercised. Now, unfortunately, we get measured quarter on quarter, but businesses cannot be run quarter on quarter. So, we have long-term relationships, and we need to calibrate our approach and the way we move on these headwinds and cost increases to the clients. So, I don't think there is any doubt on the ability to do it. The question here is that what is the rational and logical way of doing it, and when do you time it? So we need to be very sensitive and careful on that area, and which is what we are trying to do. So that at these levels, we need to pass on 7-8% to answer your question. So it's another 7-8% of price increases or thereabouts should get us back to, let's say, those 18-20% margin levels. But the thing is, we have done the last increase, and those products that we are shipping with the increased price have not even hit the shelf. Now, before that, you go back and sit with the customer. So, abhi ek retail price settle nahi hua, uske pehle hum fir ye discussion shuru kare. Business doesn't happen that way. And so unfortunately, we have to take a slightly longer term view than this our measurement criteria, which is a quarter. So so be it. But we got to protect the long term. Let's say this sanctity of the business, and also our credibility. And this at times of crisis, you need to stand with your clients and be collaborative rather than pushing through this every single increase that comes your way. So as I said, there have been instances when they have allowed us higher margins. So it's hard to pay back, and this will take a few quarters of pain, so that this we can calibrate this whole thing. But eventually we'll get there. For 15 years we have done this, and we believe that the company's business is strong enough to do it one more time.
Yeah, two ancillary questions. On the same parlance, you mentioned that about 60% is in-house. That 60% in-house would mean how many months of inventory of cotton that we normally, kind of store?
So in a normal situation, cotton is seasonal, yeah. So, the season is October to September. Normally, you tank up on cotton in December and Jan. That's when the arrivals maximize. But unfortunately, arrivals have not surged to the levels this year as one would have wanted, and which is why the spike in current prices. So right now, we are not sitting on big stocks. And to be honest, at these prices, we are not comfortable to build stocks as well. So, and these have been, as Dipali rightly said, these are all-time high prices. And, this one thing like a government intervention and the whole thing could come tumbling down, or, there's a ban on export of cotton. It happened about 8-10 years back or something, so it could come tumbling down, and you're then left saddled with very high cost inventory in your system. So we are certainly as a company not comfortable building stocks at these levels, and we will not build. Now, I'm not saying that the prices can't go up, but as a company, we are not comfortable building at these levels.
No, sir. What I meant was that if normal situations would have prevailed, then this 60% would mean how many months of inventory of cotton at your end?
Then we would have been carrying 5-6 months of cotton by the middle of February here. So this. In a normal season, we would have covered, this half, maybe 5-6 months of cotton by this time. Sure.
And coming to the flooring business, I think, two quick things. There is a massive ramp up, and, we are close to break even. Can you give some guidance, how would you ramp up this business in the current year and next year? And are the distribution channels and all of that kind of almost in place?
So, good question, and thank you for acknowledging the good work that the company has done. We believe we are going to be this in terms of top line. This quarter should be steady, and we should be steady. And the reason why we are not in a hurry to ramp up is again the same. The commodity price surge, and so this to get locked in on larger volumes of business where enough margins are not getting made. So we are not in a hurry to do that. We are waiting for the markets to stabilize. On this side, we believe they should stabilize in the next 2 or 3 months, where we believe that the commodity prices should definitely stabilize in this quarter, and which is when we will negotiate long-term businesses with our client, and hopefully the volumes will also start surging. We are not even halfway through. So this with what we can do in terms of capacity, we are not even halfway with the current volume. So there's a long way to go. There's a long way to go on the soft flooring side also. But what I can tell you is that despite COVID, we are very proud of the work that our teams have done. So for 18 straight months in a new business, there was no face-to-face meeting with the client, and with those constraints, with the hands tied to the back, we have built this business. Now the boys have started traveling, and face-to-face meetings have started happening. So this will result into a faster business development. I think internationally, we